Did you know one quiet Singapore-listed company is behind some of the world's most advanced semiconductor, medical, and industrial machines? That company is Frencken Group, cash-rich, globally diversified, and resilient even during trade wars. But is this an undervalued gem or a value trap? Welcome back to Durian Finance, where we dive deep into the smartest plays in Asia's markets. Today, we're unpacking Frencken Group, SGX, E28, a global manufacturing partner for semiconductors, healthcare, automation, and more. Two divisions, Mechatronics and Integrated Manufacturing Services, IMS. 3,600 employees across 19 global sites, serving over 50 countries. Disclaimer: the content in this video is for educational and informational purposes only and does not constitute financial advice. Always do your own research or consult a licensed financial advisor before making any investment decisions. The creator is not responsible for any financial losses incurred. Frenken's value proposition is clear. They're a one-stop shop from co-design to assembly and logistics. Their mechatronics segment builds complex subsystems for semiconductors, X-ray machines, and industrial robots. IMS delivers design and molding services for auto and consumer electronics. 2024 revenue mix: semiconductors, 46%, analytical life sciences, 23%, medical, 15%, automotive and others, remaining 16%. They aren't selling to end users, but their systems power the products you use daily, from MRI scanners to smartphones. Frencken stands on a solid financial foundation. Let's break down the company's key financial metrics for 2024 across four categories: growth, profitability, liquidity, and valuation. Starting with top-line growth, Frencken posted 794 million Singapore dollars in revenue, a 6.9% year-over-year increase, recovering strongly from the 2023 slowdown. This signals renewed demand across its semiconductor and medical sectors. Net profit came in at 37 million Singapore dollars, a 14% jump from the prior year, showing improved cost control and margin expansion despite global uncertainties. Gross margin held firm at 14.5%, up slightly from 2023. For a contract manufacturer, this reflects healthy pricing discipline and operational leverage. Operating margin stands at 6.3%, indicating Frenken's ability to maintain cost efficiency while scaling operations. The group maintains a strong liquidity position with 159 million Singapore dollars in cash, allowing flexibility for expansion, R&D, and shareholder returns. Total borrowings are moderate at 134 million Singapore dollars and well balanced against their cash position. Depending on calculation method, net cash ranges from 25 Singapore dollars to 72 million Singapore dollars, indicating that Frencken operates debt-light and doesn't rely on leverage to grow. The debt-to-equity ratio remains low at 30 to 38%, reflecting prudent capital structure. Short-term liquidity is also sound, with a current ratio of 2.1, meaning the company holds twice the assets needed to meet near-term liabilities. On valuation, Frencken trades at 6.1 times enterprise value to EBITDA, well below the sector average, suggesting undervalued potential. Similarly, EV to revenue sits at 0.6 times, a modest multiple for a business serving long-cycle industries like semiconductors and medtech. Free cash flow improved to 35 million Singapore dollars, up from 21 million Singapore dollar last year. Operating cash inflow was 48 million Singapore dollars, with capital expenditures of about 13 million Singapore dollars. This equates to a 4.4% free cash flow margin, reflecting consistent internal cash. Generation investors also enjoy a dividend yield between 2.1 and 2.9%, backed by a payout ratio of 27 to 39%, well covered by earnings. Finally, with an interest coverage ratio of 7 times, Frencken comfortably services its debt, further reinforcing its financial resilience. In summary, low debt, strong cash reserves, improving margins, and consistent free cash flow position Frencken as a stable, cash-generating industrial company with room for upside. Let's review how Frencken has performed over the past 5 years and examine why profits dipped in 2023 before recovering in 2024. What caused the 2023 profit slump? Semiconductor downturn. Frenken's 2023 was hit by a steep cyclical downturn in the semiconductor industry, leading to a 5.5% drop in revenue and slumping net profit by 37.4% to 32.5 million Singapore dollars. Margin squeeze. Gross margin fell from 15.6% in 2022 to around 12.4 to 12.5% in mid-2023 due to inflationary cost pressures, higher depreciation from facility upgrades, and lower revenue, leading to weaker operating leverage. Cost burden from CapEx. Investments in modernization, including new facilities and equipment in Europe and Asia, pushed depreciation higher, which weighed on operating income, although intended to support future growth. Macro headwinds. A slowdown in global demand, inflation, and geopolitical risks further pressured industrial end markets throughout 2023. Do you value consistency more in revenue or in profit? Type R for revenue, P for profit. Below, Frencken isn't sitting still. Invested 63 million Singapore dollars in a new U.S. facility for motor systems, expanding semiconductor production in Singapore and Asia, supporting program transfers from European OEMs, also working on a next-gen medical pathology scanner in Europe. This company is strategically reinvesting, not over-leveraging. They're preparing for the long-term chip boom. With Trump-era tariffs potentially returning, how will Frencken cope? Only 9% of revenue comes from the U.S. They operate on a China Plus strategy with production across SEA and Europe. Their multi-site footprint helps them reroute manufacturing to avoid tariffs. Plus, they serve Europe and Asia-based tech giants, not just U.S. markets. This flexible structure insulates them from geopolitics and trade shocks. To recap, diversified revenue mix, strong balance sheet and FCF, attractive valuation, growth backed by capital expenditure, not debt. If you're looking for steady cash flow, modest dividends, and exposure to semiconductors and medtech, Frencken may be a compelling candidate. Like this breakdown? Give us a thumbs up, hit subscribe, and tap the bell for more deep dives on Asia's top listed companies. Comment below. Should we compare Frencken versus Venture versus Valuatronics next?